I just lost lots of money. Here's how I did it. What is going on, everybody? My name is Matthew, and today we are talking all things pre-SPAC portfolio, otherwise known as my $23,000 secret project. Now, I want to be clear, this was not a gambling portfolio. I had very specific prerequisites for each position, and I had a strategy, a plan, somewhat defined risk, and I'll explain all of that later in this video, but for now, let's see how much I lost. So we just went through a very nasty correction, some would even call crash, in a lot of growth stocks and SPACs, which saw massive losses, losing anywhere from 20 to 30 to 60% of their value. And with that in mind, and the fact that we kind of started this portfolio right before that all happened, we actually didn't lose too much money in terms of percentage lost, all things considered. And actually, part of the reason why I want to start this portfolio back in January, kind of February of 2021, was because I was having a hard time finding good value in a lot of the growth stocks that I liked. So if I had actually put this cash into some of those growth names 3+ months ago, I might actually be down more than I am on these SPAC positions. But a loss is still a loss, even though it's a paper loss, so let's get into the lessons. So here's what I learned after holding an entire portfolio made up of pre-target SPACs over the last 3+ months of madness. I'm going to be covering both the good and the bad. So I guess you could call this my $1,753 lesson, and you guys are all getting it for free. So all I ask is that you hit that like button. I'd really appreciate it. These videos do take a long time to research, record, and edit. Let's get into the setup. So first, a bit of background on this portfolio, why I started it, what I thought was going to happen going into it, and then what ended up actually happening, and was I even close? So if you rewind a bit to the second half of 2020, a lot of these pre-merger and pre-target SPACs were suddenly popping on news of deal announcements. So the next logical step to make money off this would have been to try and buy these SPACs before they announce a merger, so you can get that easy 10 to 100% gain. I mean,
it's free real estate.
To try and increase the hit rate of this portfolio, I would look for two main things. One, an experienced management team with either good connections or really good background in private equity. And two, the target sector for the SPAC being in a space that usually demanded a high premium or lots of attention, like genomics or technology. And this worked flawlessly for CM Life Sciences, which was a genomics play. It was a pre-target SPAC that had management at Invitae and Twist Bioscience, two of ARC-G's largest holdings, and we actually saw over 100% gains on this one after they announced the merger with Sema4 and ARC bought into the SPAC. But unfortunately, that was the only one we saw any real big gains on. We did realize a bit of gains on VGAC, which was Richard Branson's Virgin Group merging with 23andMe. We sold out of that one, but we held on to CM Life Sciences because I did like Sema4 as a target business, and now that's at break even. And lastly, this brings us to the most crucial part of trying to buy these SPACs as close to net asset value or NAV as possible, and that's usually around $10 per share. The idea was to kind of treat this like a savings account where the risk was sort of defined because of that $10 floor, and the interest would be generated by pops on merger announcements. Alright, with all that said, let's get into the lessons, both the good and the bad. We're going to get the bad news over with first, but trust me, there are a few gems in the good that I took away from this experience so far, so definitely stick around for those. So one, as it turns out, the floor for these SPACs is not exactly $10 as you could have guessed. They can drop a bit further than that pre-merger, the lowest one here being $9.75 per share, but I haven't really seen too many drop below this level, and as you can see, most of them are actually at about $10 or more. Now SPACs that have already merged can definitely drop below $10. This floor does not exist forever post-merger. But again, this portfolio is pretty much all pre-merger SPACs. Some have made announcements, but haven't actually merged yet. I think the reason why a lot of these fell from their premiums of $11 and $12 is because a lot of the risk on or gambling money left the stock market in that growth correction or growth crash and moved into cryptos. And so a lot of the people who were playing this same game as I was playing in this portfolio left to seek higher returns in the crypto kind of altcoin space. And at the same time, the SPAC market got really dried up. There were now way too many SPACs and not enough companies companies, not enough good ones at least, to take public. In 2020 alone, there were approximately 248 SPACs as opposed to just 34 in 2017, 3 years prior. And before 2017, you can see just how unpopular they were compared to 2020. Thus, in addition to the speculative money leaving for cryptos, the people who stuck around, such as myself, were often getting served some pretty sloppy deals. Some target companies that weren't even in the same target sector that the SPAC initially set out to find, or some at just crazy, ridiculous valuations that didn't really make sense. So now that 10 to 20% premium of people waiting for that merger announcement was no longer warranted because the announcements usually didn't live up to the hype. But we must take away lessons from losses, that way we can still win in one way or another and become better investors. So let's get into the good that I learned from this experience. 1. Behavior like SPAC mania can definitely be a leading indicator to a bubble in certain areas of the market, and yeah, I probably should have seen that coming with a name like SPAC mania. I actually did my best to avoid the hyped SPACs. In fact, one of my most viewed videos on my channel was about how Arrival's SPAC with CIIC was not really a good deal at $27 per share, despite Kramer saying buying, UPS contracts, and enthusiastic management expectations. Now, of course, okay, I get it. This doesn't mean that Arrival won't be some massive company in the future, but I'm just saying at that time, it was clearly overvalued. And in the 7 months since, it's down nearly 30%. So it actually did stay to the more tame side of SPAC-related trading and investing, but we'll get more into that later. Now, this brings me to another lesson that is just as important. Sometimes the best trades are the ones you don't make. I've definitely made my fair share of bad trades in the past. My goal is to just make them more and more infrequent, make sure my wins outweigh my losses, and make sure I'm right more often than I'm wrong. But sometimes while we're too busy beating ourselves up for missing opportunities or buying into the wrong ones, we often forget about the trades that we didn't make that could have saved us a lot of money. Or sometimes we missed out on a lot of money, but you get the point. But to bring it back, the insane valuations and euphoric pops should have been a clear sign of exuberance in the SPAC market and in growth stocks too even. I did heed my own warning on that, which is why I tried to buy pre-target SPACs near NAV so I could find a defined floor, but I should have taken it one step further and realized that in the bigger picture, this probably means that the pops on deal announcements are also probably going to stop soon. So I guess the lesson from that would have been to continue to connect the dots, take things a bit further, and always look a little further than you think you have to. The next lesson is to stop chasing, and this is probably one of the most basic, common, and important lessons of investing, but I still had to be reminded of it again in this portfolio. My biggest loss in this portfolio by far was my position in FMAC. The stock had popped after hours on rumors that it was going to be taking Discord public, so I bought in. Being that I love Discord and it is what I literally use every day to run investor community, my emotions got the better of me and I did chase with a small position. And by the way, if you do want to join investor community, you can check that out in the link in the description below. We do live investing lessons every single week on TA, fundamental analysis, all that good stuff, and a lot more. You can try it out for a week, totally free right now. Yeah, go check it out. And the last lesson is, if you can hear the birds singing, spring has already sprung. I don't know if that's an actual quote. I heard it somewhere. It stuck with me in my head. If it's not an actual quote yet, then I would like to take credit for that, because it's a good one. If you can hear the birds singing, spring has already sprung. In other words, if everyone's already talking about it, the easy money has probably already made, or the move has already happened. And this is another crucial lesson for any beginner investor. For example, during the growth correction, you could hear a lot of people talking about rotating their entire portfolio into value stocks, but really the time to do that was back in November. And to relate it back to SPACs, I should have taken the fact that it was hard to find any SPACs near $10 or near NAV. I should have taken that as a sign that spring has already sprung. It's hard to find deals. Everything's already trading at a bit of a premium, even if there's no deal in sight. That probably means other people are already on the strategy and the easy money has been made. At this point, I was just taking on more risks than I needed to, buying SPACs at $11, some even at $12. And I guess this leads into a little bit of a bonus lesson of stick to your freaking plan, Matthew. stick to your plan, because the plan was to buy things as close to $10 as possible, and I let myself stretch out to $12, which is a 20% premium. So I should have stuck to my plan and bought a lot closer to $10 and just stayed patient. If I had stuck to that plan, the losses would probably be smaller at this point. So before we jump into what I'm going to do with this portfolio next, if you're new here, make sure to subscribe. This is not my main portfolio. Most of my money in the market is in my main public portfolio, which I've made several videos on in the past, so definitely go check those out. As far as what I'm going to do with this portfolio now, I think it's safe to say that for the most part, the deal announcement pops are over. This Financial Times article says that of 13 SPACs that announced acquisitions in May, only one is trading above $10. As recently as March, about 9 out of 10 traded above $10. But that is not to say that SPACs can no longer go up. One great example is Playboy or PLBY Group, which has seen over 3x since its deal was announced, and that's because the deal valued the company so cheaply. And I actually have a full deep dive on PLBY in the corner right here for you if you want to go check that out. So the conclusion is that if you're going to try and make money in SPACs these days, I think it's going to be a lot harder. You're going to have to get your hands dirty, do a lot of research, dig into these filings, dig into how they're valuing the company in each deal. You probably can't just kind of spray and pray. So I'll probably slowly scale out of this portfolio as I need the cash, but right now I don't really need the cash, and a lot of these SPACs have already sort of found their floors and are trading still near NAV. However, if this weren't sort of like an ongoing experiment for me and I was just holding a normal portfolio, I probably would not put too much of my personal money into pre-target SPACs in hopes that they will pop. I would probably put my money either in cash or a high yield account like BlockFi, or I would deploy it into individual stocks that I like much better. And that's simply because there's an opportunity cost in holding these SPACs. They could go on for 2 years and still not have a deal, or they could have a deal but you have to wait a year and a half to get there. So every once in a while, I'll probably update you guys on this portfolio, but my main focus is going to continue to be my main portfolio, and make sure to subscribe again for more videos on that. Check out the quote of the day. You might just learn something. Make sure to follow me on Instagram for daily posts about my portfolio, stocks I'm watching, and all that good stuff. And if you're watching at this point in the video, you are the real MVP. Don't forget your peace and thank yous.